Hey everyone, Chris Spiering with Dallaire Realty. If you're looking for a property in the Brown County area and you've talked to anybody about real estate, you've talked about the word rates. Everybody's interested in the rate environment. Today we have Seth Johnston from Associated Bank to clear up some of that fog and really talk about the rate environment. Seth, thank you for joining us
You're
on the
welcome.
cast today and talk about today's rate environment.
So this is one of the biggest questions that we get up because we are in a very turbulent time right now with rates in 2023. It's a very confusing. We get that question, is this the right time to buy? Should we be waiting? Should we sell? What does that look like? The rates can have a drastic effect. If we looked at rates that were done in 2020 or 2021 at 2.875 versus a 7% rate, the same house could have a 40% higher payment with that rate difference. So is that going to keep someone from wanting to put their house on the market? Is that going to make someone say, you know what, I just can't walk up and down these stairs anymore. We just got to get a ranch, or we want to move out into the country. But what's up with these rates? How do we handle this? What does this mean? So let's talk about that for example. Right now, it's March 9th, Thursday morning. Rates on a 30-year fixed are floating somewhere around 6.625 on a 30-year fixed. Okay. In the last, I don't know, I'm probably wrong at saying this, but let's just guess. In the last 60 days, I would say the spectrum of the 30-year fixed has been as low as potentially 5.75 and maybe as high as maybe the high sixes, almost a 7. Okay, so that's our spectrum as of today. Is that a good rate? For sure. Why do we feel that it may not be a good rate? Well, let's challenge our perception of what a good rate is for a moment. On any rate environment talk, you may think about a bell curve. So, goes something like that. Okay. If we look at the extreme highs, that would be defined as the early 80s, where you would see rates from 12% all the way up to 16%. And we might hear about our parents' generation saying, oh my goodness, rates were so high. You should have heard the rate on our first mortgage. It was 13%, 12%, whatever. We took all our disposable income, everything we had. We paid that thing down as fast as humanly possible. We didn't even go out to the movies. We took every penny that we had and we paid that down. We played cards in the basement with our friends at night, everything to save our money. Well, the flip opposite happened, where those were the extreme highs in the early mid 80s. The extreme lows were post world traumatic events to keep the economy from collapse. So let's think about 2008. Let's think about the pandemic of 2020, where the government came in and put an enormous amount of money in to keep rates low. They subsidized the market, so to speak. So after 2008, after specifically 2020, we could have seen a 30-year fixed. I think maybe the lowest 30-year fixed I've ever seen was 2.5%. Crazy, crazy, crazy. Now, after that subsidization of that money stopped and rates went back to normal, what defines normal? So if we take the extremes out of the lows from 2008 to maybe 2010, that 2-year spectrum, 2020 to 2022, that 2-year spectrum in the 2s and the 3s, and we take out the extreme highs of the early 80s in the teens, normal is typically defined on a 30-year fixed as 4 to 7% on a 30-year fixed, 4 to 7%. That's a 3% variance. That's actually a very tight variance of only 3%. Where are we today? Right in that variance. Therefore, we are in normal rate times. So when you're looking at buying that right property and it's for you, you can't go up and down the stairs anymore. You're sick of living in town. You want to get out to the country. Your job is in another place. You've just got to get a new place. You got to get a different place. The rates are something you just get whatever the times are calling for. This is the rate today. You take that, you close your loan, you get your beautiful property they've been looking for, and then you do what everybody else has always done. You just refinance. It's fine. You already own the property. There's no stress in it. Just give me a call. Just say, hey, Seth, where are the rates at? Does it make sense? We do a break-even analysis. Here's the cost. Here's what you save. Here's your payment difference. Are you going to be in the house more than these amount of months to break even on it? If the answer is yes, then I would recommend it. It's very normal. People have been doing it for a very long time. So take that off your stress. Get the property that you've always wanted, take the rates, whatever it's at. When the rates go lower, if that's going to happen, then you can refinance. But in today's time, we are back to the normal rate environment. So I hope that helps.
No, we saw it does, definitely. And what we saw for a brief period of time was a lot of adjustable rate things happening versus fixed. Talk about why that happened, and has that changed and shifted?
Yeah, so adjustable rates have been really popular in places like California, environments where the prices of homes are so extremely high compared to the conservative Midwest that you do anything you can to get that payment down, just because the cost to acquire that size home is almost unbearable compared to where it is in the Midwest. So the rates out in California, coastal areas, are more normal than the traditional 30-year fixed in our conservative Midwest place. So post 2020, the ARMs were funded out of a bank's portfolio funds, the own bank's money that it loans against maybe your savings, your checking, your deposits. Now, that amount of money that we can loan against doesn't go forever. Sometimes that amount of money is used up and then it's reallocated at a different time when they have to refill the bucket, so to speak. So when those portfolio funds were exhausted, that may have been priced at 3.875. And now today, the ARMs are not that much different than a 30-year fixed. People now would take the 30-year fixed market instead of the ARM because there's just no benefit in the rate anymore. And now where we have inflation, we really don't know where this is going to end up. I would just hate to see a client take a slightly lower rate that's only guaranteed for 5 years. But in 5 years, when that rate expires, the environment then is significantly higher than where they could have locked for a 30-year fixed. That's a big problem. Plus, there's the old-fashioned, it keeps you up at night. You don't know. It makes someone worry. People in the Midwest are very conservative. They don't like worrying about that kind of stuff. They just say, hey, I want to know what my rate is. I want to know it's not going to change. So we just don't do a lot of ARMs anymore. We did after the rates went up from 2021 to a little bit in 2022, but now we're back to the popular 30-year fixed again.
Thank you, Seth, for joining us. I think you cleared up a ton of questions for us on the rate environment today, which is ever changing. If you have any questions or you want to get more specific on the rates and find out what it may take to jump into the real estate market today, we're going to put Seth's information below, and we'll have ours there as well. If you want to talk on the real estate side, we're happy to earn your trust there as well. So Seth, thank you for joining us today.
Thank you, Chris.
Hey, it's my pleasure. And we look forward to having some people reach out and learn about this rate environment.
Yeah. Thanks, Chris.
You bet.